This presentation reviews Orex Minerals Inc. as of March 13, 2026. The key message is that Orex is no longer a typical multi-project junior explorer. It has shifted into a more focused, event-driven mining story centered on monetizing its stake in Coneto. At the same time, the company has reset its balance sheet through a major financing, which improves short-term stability but changes the investment profile. The goal of this analysis is to assess whether Orex offers real upside, or whether the risks around dilution, asset concentration, and execution remain too high. At an executive level, Orex's current positioning is much narrower than before. The company has moved away from a pure exploration identity and now looks like a hybrid story involving optionality, asset monetization, and selective project management. Coneto is clearly the main value source, while non-core asset quality is weaker. The portfolio has also deteriorated outside the flagship asset, with Sandra impaired and Valenciana no longer part of the forward story. For investors, this means Orex should now be judged less as a diversified junior and more as a catalyst-driven special situation. The Orex investment case rests on four pillars. First, the Coneto stake remains the core value anchor and the main source of potential value realization. Second, the March 2026 financing has materially improved the balance sheet and reduced immediate survival risk. Third, there is still some upside optionality from other projects, especially Jumping Josephine, even though it is not yet active. And fourth, management now has an opportunity to reshape the company into a stronger long-term story. So the thesis is not about broad exploration anymore. It is about focused execution and value unlock. The core narrative around Orex has clearly changed. In the past, the company looked more like a conventional multi-project junior explorer with financial strain and exploration-led growth ambitions. Today, it is a more focused asset monetization story with selective project management and a recapitalized balance sheet. The portfolio has become narrower, with non-core assets contributing less than before. This shift is important for investors because it changes how Orex should be valued. The company is no longer mainly an exploration upside story. It is now much more dependent on successful strategic execution around its core asset base. Orex's financial outlook has improved, but the improvement comes with trade-offs. The recent $5 million financing significantly reduced immediate liquidity pressure and helped stabilize operations. That is a clear positive after a period of financial weakness. However, the same financing also created major dilution, which weakens per-share upside. The other key issue is that Orex remains highly event-driven, with the proposed Coneto sale acting as the main near-term catalyst. In other words, the company is more stable than before, but still highly speculative, and the stock will likely continue to trade based on upcoming catalysts rather than steady fundamentals. Share structure is one of the clearest weak points in the Orex story. The company moved from about 36.22 million issued shares before financing to an estimated 66.76 million post-financing, with fully diluted shares potentially reaching roughly 108.6 million. For a junior miner of this size, that is a heavy structure. It creates substantial warrant overhang and reduces leverage per share if metal prices rise or if the company creates value. So while financing improved the treasury, it also weakened the capital structure. Investors need to recognize that dilution is now one of Orex's biggest structural constraints. Looking at the project portfolio, Coneto stands out clearly as the strongest asset. It remains the flagship, the core value anchor, and the project actively being monetized. By contrast, Sandra has been impaired and contributes very little value today. Jumping Josephine still offers moderate optionality, but it is currently inactive, and only speculative future spending supports its relevance. Valenciana has effectively been dropped from the story, so the portfolio is no longer diversified in any meaningful value sense. Orex is now largely a one-asset-driven thesis, with only limited secondary optionality beyond Coneto. Management and strategic direction have improved, at least in terms of alignment with Orex's current needs. The new CEO and CFO suggest a strategic refresh, with more focus on capital markets, restructuring, and monetization, rather than broad grassroots exploration. That fits the company's present reality. Market credibility has also improved somewhat, especially with Eric Sprott involved in the financing. However, Orex is still in the proof stage. Management strategy makes sense on paper, but long-term value creation still has to be demonstrated. Investors should view this as a better aligned leadership setup, but not yet a fully proven execution story. The company's near-term plan is relatively clear. The new financing provides a strategic financial base by preserving property holdings, covering obligations, and keeping future options alive. The main investment catalyst remains the Coneto transaction, which still needs to close. Beyond that, Jumping Josephine represents the most realistic optionality within the existing portfolio, while Sandra appears unlikely to contribute much in the near term. If the Coneto transaction is completed, Orex may then be able to reposition itself around new transactions or a refreshed exploration strategy. So this is really a bridge period between recapitalization and whatever the next chapter becomes. Using the mining assessment framework, Orex scores 68 out of 100, which places it in the category of speculative but worth watching. The strongest category is asset and exploration quality, mainly because Coneto is a legitimate flagship asset. Financing has improved enough to reduce immediate survival concerns, and management scores reasonably well because of the strategic reset. However, jurisdiction risk remains mixed, and capital structure is clearly weak due to dilution. So the overall score reflects a company that still has upside and a real asset base, but also meaningful structural weaknesses that prevent it from being a high-quality investment today. The risk scorecard highlights why Orex remains a high-risk setup. The overall risk score is 78 out of 100, which is firmly elevated. The biggest issue is dilution risk, followed by dependence on a single core asset. There is also meaningful transaction risk around the Coneto sale, because if that process fails or is delayed, the value unlock thesis weakens quickly. Historical financial weakness also matters, even though the recent financing improved short-term stability. Finally, portfolio deterioration outside Coneto reduces strategic flexibility. Together, these risks explain why Orex is interesting, but far from a low-risk junior mining investment. The scenario analysis helps frame the possible outcomes. In the bull case, the Coneto sale closes on favorable terms, and Jumping Josephine is reactivated, creating a strong re-rating opportunity. In the base case, the transaction closes and the company stabilizes, but new value creation remains slow, leading to only moderate upside. In the bear case, Coneto is delayed or repriced, dilution dominates the story, and no second asset gains momentum. The stock would likely remain weak and speculative. For investors, this means Orex should be approached as a catalyst-driven setup where outcomes depend heavily on execution and follow-through. The positives and negatives are fairly balanced, but not equally powerful. On the positive side, Orex still has a legitimate flagship asset in Coneto, improved liquidity after the March 2026 financing, and a somewhat stronger strategic outlook thanks to management repositioning and market support from Sprott. On the negative side, dilution is severe, the non-core portfolio is weak, and the investment thesis depends heavily on one transaction closing successfully. That creates a very asymmetrical setup. There is upside if the company executes well, but there is also a narrow path to that upside, which limits Orex's appeal to more speculative investors. This stock is not suitable for everyone. Orex may appeal to speculative mining traders or investors who focus on special situations involving asset sales, recapitalizations, and event-driven setups. These investors may be comfortable waiting for a catalyst like the Coneto transaction to unlock value. However, Orex is not a good fit for conservative investors, for those who want broad precious metals exposure, or for long-term growth investors who need a clear multi-year development strategy. Without a defined post-Coneto roadmap, the company remains too uncertain for more traditional investment styles. Suitability depends heavily on risk tolerance and investment objective. The final conclusion is that Orex has transformed into a high-risk, event-driven mining stock. The upside exists, but it depends primarily on the Coneto transaction and management's ability to execute after recapitalization. That means Orex should not be treated as a stable, broad-based exploration company. Instead, it should be monitored closely as a special situation. Investors should watch the progress of the Coneto sale, follow how management deploys capital, and look for signs of a credible strategy beyond one core asset. In short, Orex is a watchlist name for speculative investors, not a clear conviction buy today.